Gold is an anticipatory market. I don't think gold follows Fed speeches, doesn't care about today's interest rate. It cares about what do all these tectonic plates moving around, the stock market, the bond market, so forth, foreign exchange. It's not any one of those, and it's not always the direction you think it is. If the bond market collapsed that we just saw, took out the October low, why didn't gold do the same thing? Because it seemed to be in sync with it last year. Well, it's not now. I think what gold is looking at is the factors that come together that point in the direction of central bank panic again. And it's seeing those factors now. You're seeing a crash in the most important debt market in the world.
MichaelOliver, a prominent figure in momentum structural analysis, has articulated an intriguing perspective on the shifting dynamics of capital allocation from financial assets to hard assets. According to Oliver, gold's valuation doesn't always adhere to the decisions and pronouncements of the federal or current interest rates. Instead, gold appears more attuned to significant movements in other financial markets, including stocks, bonds, and foreign exchange. When the anticipated or actual returns on bonds, equities, and real estate begin to wane, there tends to be an upswing in interest in gold as an investment, consequently driving its price higher. Conversely, the value of gold tends to recede when investors pivot towards traditional investment options such as stocks, bonds, mutual funds, and the like. This perspective gains additional context from recent developments, as the Federal Reserve has issued warnings of more imminent interest rate hikes to combat inflation. Gold, notably, displayed a lack of clear direction on September 25, 2023, following a modest gain the previous week. This uncertainty in the gold market comes as investors evaluate the Federal Reserve's decision to signal further interest rate increases, coinciding with the impending release of consumer inflation data later this week. It is worth noting that last week, despite expressing uncertainty about the conclusion of the inflation battle, Fed officials voted to maintain the benchmark rate without adjustment. Oliver suggests that these actions by the Federal Reserve are contributing to disruptions in financial markets, leading to peculiar behavior in the gold market. This strange behavior, in turn, hints at a growing loss of confidence among investors in the Federal Reserve's ability to manage the economy effectively. Before diving into MichaelOliver's insightful interview, subscribe to our channel and give this video a big thumbs up.
The Fed has gone too far, has bust the bubble. These guys are suspicious of the stock market, suspicious of the bond market, but I think that's going to change because it's going to start to behave better. And one thing that I think they bought, and I don't have an inside view of their portfolios, but I've seen the statements they make, is the gold market. Why would they buy gold if the Fed's going to fight inflation? Inflation being, gold, the barometer of inflation. So the gold should be collapsing once they started raising rates last year, okay? What collapsed? The bond market, the stock market. Gold had an unchanged year in the year 2022. Closed in the 1820s, that's where it closed in 2021. How come gold didn't go down last year despite the Fed raising rates? In fact, gold's now $100 above that, despite the ongoing rate rises. How come? How come it's so bleeding steady up there? 1900, 2000, 1800, 2000. It's 3 years now. It's never behaved like this before. You go back and look at any prior gold bull market top, 1975, 1980, 2011. They were isolated spike peaks, and when they dropped, they never went back to the high. They floundered around and then ultimately collapsed. This time, we went back to the high in 2022 and back to the high again this year. What's going on there? That is something underlying is going on. And I think what's going on is ultimately smart money knows that the central bank can't play the game anymore. And that ultimately when they have to switch back to defend their collapsing bubble, that means monetary excess again, probably lowering rates. That's not really an issue, the short end of the market. The main thing is the Federal Reserve and other central banks cease their policies and go back the other way, that which they do the best. Monetizing debt, buying assets on their balance sheet, which the Fed has really not given that much up, by the way. And this time they're doing it, will have to do it because their particular market is the one suffering the most, the T-bond market. What's going to be the beneficiary of that? Ultimately, it's going to be gold and monetary related assets. In fact, gold was bottoming in late 1999, early 2000. Around $250 an ounce. And between 2000 and 2002, gold rose. No, it didn't explode, but it rose. All that time, the stock market went down. Okay, that goes out the door. Okay. Back during the Great Depression, gold was controlled. Home stake mining wasn't. Home stake mining went up like many multiples, all during the great bear market of stocks. Okay. 2007 to 2009, net on balance, despite the October interruption, gold rose. In fact, gold had been rising since 2000, and the 2008 drop that it suffered was merely a mid-trend correction for gold. Okay. Went up from 2000 to 2011. Part of that was in sync with the stock market. Good chunk of that was out of sync with the stock market. The correlation's not that good. Last year was another good example. You had a very bad year for the stock market. NASDAQ, the leader index, down over 30%. Gold was unchanged. Oh, I thought there's supposed to be a correlation, right? Okay, no, there wasn't. Okay. Gold has been around longer than any of these paper assets.
Gold prices have grappled with downward pressure in the face of a weaker dollar, struggling to breach the formidable resistance level of $1,900 per ounce. As the week drew to a close, gold prices were bracing for what could be their most substantial monthly decline since February. The precious metal hovered around levels not seen in over 6 months, primarily due to mounting expectations of higher interest rates in the United States. Gold has endured a challenging month, facing a nearly 4% decline, marking its second consecutive quarterly drop. Nicholas Frappel, the global head of institutional markets at ABC Refinery, highlighted the gold market's reaction to the Federal Reserve's messaging. The market has absorbed the central bank's indications of an extended period of interest rate stability, contributing to the downward pressure on gold prices. Oliver, a notable figure in the field, highlights a contrasting perspective. He emphasizes that gold has exhibited remarkable resilience and has retained its value admirably, even in the face of adverse predictions. Oliver underscores the importance of taking a step back and considering the broader picture, cautioning against being overly fixated on short-term fluctuations.
A lot of people are bearish on gold and skeptical, despite what I've argued that, how come it's hanging around near the highs with it? Right now, for example, gold's trading 3.5% below its all-time high monthly close, which was February this year, 1999 and change. We're trading at 1910 or something. So 4% below the all-time high close. And it's been, 9 months, 8-9 months? The selling pressure hasn't been able to collapse it. So people who think gold has to collapse because the market's going to... Gold collapsed in September, October of last year. You had this price range that anybody could see on a price chart. You blew out the bottom of the box. Again, anybody with a crayon could have drawn it. It came through at 1675. You hit it. Finally, last summer, you broke it. Okay. Everybody said, gold's over. It's going to collapse, going to 1200, et cetera, et cetera. Nobody was bullish except us. We said, no, it's a bear trap. You got down to 1613, which is 3.5% below the price breakout level at 1670 area. And within about 6 months, you're back to the high. Boom. No news stories, just said, I'm back to the high again. Now, you want that to happen again? You just had your crash, guys, and it didn't work. So it got cleansed. Anybody wanted to get out of the market was forced out. Anybody wanted to get major bearish had good reason, and it blew up in their face. So I think gold is talking. Don't look at its day-to-day, incremental, week-to-week stuff. Look at the broader picture of what it's been doing since the surge that peaked in January of early this year. Gold was 1940-something. Later, it went up to over 2,000 again. But in January high of this year, gold and silver both hit a peak. Silver was around 24.5 at that point. It had been at 17 almost in October or September of last year. Silver pulled back under 20. Gold pulled back down into the 1800s. But since then, if you draw a line across where that first surge early this year occurred, after the September lows of last year, and draw a line horizontally, silver and gold have been doing this on either side of that price. For all these months, people doubters, selling. And yet they can't seem to get it sustained. And I think there's a reason for that. That crash was later taken out in March of 2009. 2008 low. Now, yes, gold did suffer a bit during that drop. There was about a 4-week process where gold said, I'll join you, although gold had been rising all during that time. And then later, gold was back to its high where the S&P was making new lows. Okay. But we don't have any particular reason to expect a crash type event. It's not historically normal. In fact, that one crash that I actually personally caught, not in a big way, but caught, it was the 87 crash. Before I set up momentum structural analysis in 92. That crash would come and went in 2 weeks. I could see it clearly on momentum charts that something big was going to happen. And fortunately, I caught it with some minor put position. But that didn't lead to a bear market. In fact, that was a buy point. When that thing crashed, it went down to what we call annual momentum support and turned around and trended up again. So even that crash is not part of a bear market. So crashes are highly abnormal. Don't expect it. Doesn't mean don't expect blood. It just says don't expect it to happen overnight. That's what we expect now, is probably a layered, persistent decline that lasts a year or two and reaches great depth levels with major in the street consequences for the average person. And we think the beneficiary of that will be when the central banks panic to try to solve this problem, which they help create the boom bust cycle anyway. Gold will be the prime beneficiary in terms of assets.
In light of these contrasting perspectives on the behavior of gold in response to Federal Reserve actions and the broader economic landscape, how will investors navigate this intricate interplay between traditional assets and hard assets like gold in uncertain economic conditions and potential interest rate hikes? If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.